All right, everyone. Welcome to my new series called Basic Trading. This is episode 1, and it's going to be on managing yourself. My goal here is to create a series of videos to help new traders or even seasoned traders who are looking to understand, the way I think about trading and kind of some of the tips and tricks that I have based on my system and based on my trading experience. So we're going to start this one off with what I think is probably the most important aspect of trading, which is you. I've said this in the past, but you are in the end the final boss. You have to conquer yourself in order to become good at this. And that's actually true of anything that requires skill. So some of the stuff that we talk about today is, I think, going to be applicable to broader life, and I'm sure you'll see many things I talk about here that are pretty common to almost anything that you do that requires skill in life. So with that, I just want to remind you that this presentation is not financial advice, and I'm not a financial advisor. So anything that you see here, anything you see on my channel, I'm making it available to you for your benefit, but ultimately you have to take responsibility for your own trading. With that, let's begin. So we're going to walk through a bunch of things today. We're going to talk about expectations and managing expectations around trading. We're going to talk about growth mindset, discipline, emotion, risk management, including some examples, and we'll close it out with discussion around continuous improvement. Ultimately, you have to set the expectations right if you want to be able to trade effectively. And at the end of the day, trading is a business. And if you go in with the right expectations, you'll be in a better position to do things the right way. And if you don't, well, you're just gambling. Trading is a business. You're here to use capital, your startup costs, and your trading system to generate more capital, which is your revenue. And then you're going to minimize drawdowns, which are your losses, in order to produce more capital, which is your profit. And you have a P&L statement that goes with it as well. And you get to look at that P&L every day, the bottom line at least. And despite all the glorified takes that you see in traditional social media, obviously it's very exciting to see great trades being made, $1 million, $1 billion, $10 billion trades being made. Ultimately, it's not easy to do trading, right? It's not easy to trade. So like any business, you have to avoid getting discouraged by any short-term losses or slow growth in the beginning, and understand that, this is a business. So your goal should be consistency and steady progress up and to the right. Having the right mindset as you approach this business is really important. My favorite teacher used to say, attitude precedes action. If you have good attitude, it's likely there's going to be good outcomes that come from it, or at least learnings that are going to come from it. If you have a bad attitude, well, everything feels horrible all the time. So it's really important to have the right mindset and attitude as you approach trading. It might be more important than any other thing that you do for yourself. And so it's important to go into trading with a positive attitude and have hyper focus on learning, not on perfection. You want to be able to go into any situation, whether it's a win or a loss, and end up with not only either some capital gained or capital lost, but also an understanding of how you might be able to do things better the next time. And trading's not easy. If you embrace the challenge of trading, and you really truly embrace it, and you look at it with the right mindset, with a growth mindset, you'll start to see losses and setbacks as opportunities to learn and grow, rather than something that's sort of like the end. It's not the end. It's just one trade and something that you can learn from. And, to that point, mistakes are your best teachers. If you're willing to learn from them, they are. If you're not, they can be your mortal enemy and completely destroy you. But if you approach mistakes with the right mindset, with a growth mindset, you can truly learn a ton from them, and those mistakes can be a stepping stone to greater success. And so having a growth mindset and the right attitude is essential in not just trading but everything in life. It's really the right way to approach life. And by having that mindset in place, you'll be focused on continuous improvement, and that's going to lead you to the path of long-term success. Let's talk a little bit about discipline. One of the hardest things in trading and perhaps life is having discipline. Anybody who's tried to wake up early, tried to go to the gym, tried to not eat potato chips or pizza or burgers or whatever it is, whatever your favorite food is that you probably shouldn't eat so much of. It's hard. It's not easy, right? It's very hard to have good habits on a regular basis. Of course, there's lots of ways you can define discipline. There's standard dictionary definitions, but I'll use a simple definition that my dad shared with me when I was younger, and that is discipline is the habit of doing what you need to do. Right? There are things in life that you need to do in order to be healthier, in order to be better at your job, in order to be better at trading, in order to be better at your family life. And those things those habits need to be part of a regular activity. And your willingness and your ability to do those things is really your discipline, right? And if you want to be disciplined in trading, I think the discipline that you have in everyday life is going to spill over. Your habits and your willpower will be reflected by the market. A lot of those things are, for older folks, that might be habits that you've built over decades. For younger folks, you may have just recently built some bad habits, and those will be reflected by the market. And so, normal things, proper diet, exercise, sleep, they can all help, right? It's pretty common sense stuff. The better you take care of yourself and think of yourself as more like an athlete, if you're a trader, the better you take care of your body and your mind, the more likely you'll be able to be in a position to have a chance at success. So, that being said, being disciplined in life is kind of it's kind of off topic. It's related, obviously, but I don't really want to get into too much of the detail on how you can do that for yourself. If you're interested, I highly recommend the book Atomic Habits by James Clear. It's probably one of my favorite books just on, general discipline and productivity, and I think you'll find it incredibly enlightening. Being disciplined in trading comes down to three very important habits. The first thing is you have to have some form of routine, and really this should be like a daily and a weekly routine. You can of course have monthly and etc. There's always monthly events and things like that, so maybe preparation around that as well. But really, at minimum, a daily and a weekly routine where you are planning, trading, reviewing, journaling, and of course learning from everything that you've done. So that's very important. I'd say that's the first habit that you need to develop. A little bit of insight into mine. Obviously, you guys who follow me know that I post a daily plan every morning, or most mornings, for SPY and also SPX if you're in the Discord. And, I regularly on a daily basis will review charts and on a weekly basis as well. I'm looking at charts on the weekends, usually not on a Saturday. I take Saturdays off, but Sundays I'll start to look at things again and start to plan out the week and look at the week. Mondays are really my big planning day for the week. I like to ease in the Mondays and then figure out what's going to happen for the week and potentially post ideas. So, coming up with some sort of a routine around, how you plan, trade, review, journal, and learn is very important. Second thing, very obvious, you have to have some sort of system for taking trades, for finding trades and taking trades, and of course, managing your risk. And this can be, there's hundreds of different systems out there. Nothing is perfect. There There are many, different styles of trading, different instruments you can trade, and various systems that address those. So having some form of a system that indicates to you when you need to get into a trade, when you need to be out of the trade, and whether that's an exit or for profit or a stop, you need to have some sort of system. And then, that system should allow you to build a plan around every trade. And the third piece is sticking to that plan, not deviating. It could be a drawdown against your initial entry, and, maybe it's violent, but still within your risk. Let it play out. Don't let your emotions take you out of the trade. Unless there's something technical in your system that says, hey, you need to be out of that trade. Stick to your plan. Don't if your system's been tested and you've refined it and you've tested it in with real money and it's been good for you and profitable for you, you got to trust it. Be patient. Have confidence that it's worked out in the past. It's been back tested. It's been tested with real money. You feel confident in the system. You have to just believe in it. You have to trust it and stick to the plan. Understand there's going to be infinite trading opportunities. If you look across all the different instruments, all the different tickers, the various different time frames and types of trading, whether it's scalping, day trading, swing trading, position trading, long-term trading like investing or leaps. There's an infinite number of trading opportunities. So just wait for your system to tell you there's an opportunity and then execute your plan. Don't deviate from it. Just take care of business. So, that being said, the biggest thing that's in the way of you and your trading discipline is your emotions, and fear and greed, as every single person who's listening to this right now understands, are the biggest emotions in trading. We even have fear and greed meters. But, the fear of past losses will freeze you from entering a good trade. You're so scared about what's happened to you in the past, you're unwilling to actually get into something, even though your system's screaming at you that this is the right trade. How many times has that happened to you, right? Where you just, you feel scared to get into it, and then it passes you by and it works out exactly the way that you wanted it to work out, right? Fear of loss will take you out of a trade early. Something goes against you, right? We were just talking about this a second ago. It goes against you. Maybe it's a violent move against you, but your system's saying, hey, don't get out of the trade, right? But your fear of loss, because you've lost so many times in the past and you have PTSD from losing, you just get out of the trade, and then all of a sudden it bounces back and goes in your favor and works out exactly the way you wanted it to. Fear of missing out, FOMO. You start chasing a trade late. Maybe you get into a different trade, right? Your focus is on one trade. You have a plan. You get impatient. You start seeing something else, running, or you see something in a chat or on Twitter, or your friend tells you, hey, this thing is running. And then you stop looking at your trade plan and you start looking at something else. And then you start chasing that. That doesn't work out, and then you miss out on your opportunity, which ends up working out. Fear of being wrong will lead to bad decisions. An ego will kill your account. The desire to be right, because you just don't want to be wrong, you're afraid of being wrong. How many times have you been in a trade where, it's gone against you? Let's say you took a out of the money contract and it goes against you. And instead of exiting the trade, you're afraid of, being wrong. You want to be right so bad, even though your system's saying get out. So you just average down, right? And then you feel better for a second because you're like, oh, my percentage average goes up, right? You're not it doesn't appear like you're down as much, but you're actually in worse shape now, right? You have put more capital, more principal up front. That can now go down even further, right? So fear of being wrong is going to lead you to terrible decisions. And the ego from that the desire to be right and making bad decisions will blow up your account. You wouldn't be the first person that's happened to. And on the flip side, greed is the other emotion. Make you take risks you shouldn't take. You'll start trading things willy-nilly, just randomly trading impulsively. You'll oversize. You'll start doing silly things. Maybe you had a great win or 10 great wins or a week's worth of wins or a month's worth of wins. Maybe you start feeling it 90 days after, really testing yourself. You're really in the zone and you really start to feel like, hey, I can do this. And then you start getting super greedy and you're like, hey, you know what? I was doing it with one contract. Let me try 20. Let me try 50. Let me try 100. Next thing you know, you have no account, right? So greed will make you do some crazy stuff. It'll also make you stay in trades too long. I mean, how many times have you been in a trade where, it's going in your favor? Let's say you're up 20% or 30% or 50% or 100%. And you're like, oh, well, I think it's going to go more. And you don't take profit. And then the trade goes against you and you're like, well, it'll go back, right? It's going to go back. It's down from 100% down to 20%. Oh, it'll go back to 100%. Next thing you know, you're at minus 20%. So you let a 100% trade where you got a double on the trade go back to below, to a loss. Greed will make you do that. And then, let's say that happens to you and then you get out of your trade at a 20% loss, right? After being up 100%, now you're pissed and you want your money back, and greed's going to make you take revenge trades after losing, right? Let's say you won that trade. Let's say you did take profit at 50% or 100%, whatever it is. Well, then greed's going to make you, if you don't handle it, greed's going to make you take random trades after winning, right? You're just like, you want to feel that again. You want to feel that dopamine release again. It felt so good to win, and you want to do it again immediately, right? And so you'll just start randomly trading. Before you know it, all the gains that you had are gone as you trade them away randomly instead of trading off your system. And then you'll just keep doing that over and over. Greed will make you overtrade, right? You won two trades today, 3 trades today, or 2 trades this month, or whatever time frame, however you like to trade, whether you're a day trader or swing trader, whatever. You won 2 or 3 trades, and now you're like, hey, I'm just going to keep doing it. And you start overtrading, and you stop trading real setups, and you just start to go into the abyss. So fear and greed are incredibly dangerous emotions if left unchecked, and definitely for trading, the two that we struggle with the most as traders. And the solution is very simple. You just have to stop trading impulsively and then switch that to trading systematically, having discipline, right? Or as I like to say, trade like an algo, right? If the system says go long, you go long. If the system says go short, you go short. If the system says, hey, we're going to probably chop, you sell premium. If the system, or, sit, don't do anything. And the system doesn't say that you should do anything, you do nothing, right? And of course, this is easier said than done, right? It's very easy to talk about this at a high level, but it's harder to do it in action. But ultimately, that is what your job is. Your job is to have your system, to build your plans around what you want to trade, and then just do it and not deviate from it. Don't let your emotions control you. Don't trade impulsively. Just trade like an algo. And after you complete a trade, you have to reset. At the end of every day, you have to reset. At the end of every week, you have to reset. Every moment in the market is unique. You have to trade your system. You have to trade like an algo, and then you have to reset. So, ultimately, emotions are just a natural response to your thoughts and environment. You have senses. You process that data in your mind, and you react from that, right? You feel something. And you don't want to suppress that, right? Because in many cases that is a valuable thing. It can save your life. Suppressing it is not the answer. I think that's a mistake that a lot of people, this is something, I'll just argue, not as an expert on the psychology behind this, but just as somebody who believes that controlling your emotions, suppressing your emotions is not the right approach, right? That I think a lot of people believe that you need to just control them, suppress them, push them away. No, that's not right. The correct approach, in my view, is to be mindful and present. It's okay to have emotions, but you don't have to act on them. And I think there is a great tool that we have in humanity that we can use to practice this, and that's meditation. And so that's what I do to be present, right? To not allow my emotions to take me over, but for them to still exist. I'm human, so emotions are going to happen, but I don't have to react to them if I don't want to. That's a choice you can make. And to practice that, I do meditation, and you can read my meditation routine. But essentially it's 2 sessions per day, 20 minutes in the morning, 20 minutes at night. Sit still, focus on breathing. Thoughts and emotions are going to appear. As they appear, I refocus on my breath. And that's it. I suggest you try it for 90 days. I think if you're disciplined about it, you'll probably see a difference. But I find that is the best way to just be present, see what's actually happening, and then objectively take action on what you need to take action on. So with that under control, now we've talked about discipline, we've talked about emotion. The most important thing for profitability is risk management. I know a lot of people have been waiting for me to talk about risk management a little bit more. And so I'm going to get into it a little bit, and we'll get into some of the details. This isn't going to be, a magnum opus on risk management. I'm sure there's a ton of other stuff out there that you can look at, but I think it should give you a basic idea of what you need to do, whether you're a, commons trader, futures trader, or an options trader. But the basic idea of risk management is wins should be bigger than losses, and losses should be small. I'm going to repeat that. The most important aspect of risk management is wins should be bigger than losses, and losses should be small. Okay? That's how you're going to manage your risk, right? If you manage the downside and you get good upside, you'll go up and to the right. If you don't manage the downside, even if you have good upside, you're going to go down and to the right until your account's gone. So wins should be bigger than losses, and losses should be small. And it's more important to be profitable overall than to win every trade. And profitability is going to come from risk management, right? By having bigger wins than losses, and then keeping those losses small. So focusing on execution rather than any individual trade's outcome is the focus, right? That should be the most important thing that you do. You want consistent small wins. And not focus too much on, big trades, right? That's not the objective here. The focus is on the execution, not on the money. And as Bill Walsh famously said, the score will take care of itself. Compounded gains will add up over time. You don't have to worry about that. If you're executing you're against your system, and your system is one that's been proven to be profitable, you're going to be just fine as long as you manage your risk. Now, the hardest part about risk management, it's easy to talk about, right? We can say wins should be bigger than losses and losses should be small. Of course, Sadi, that's obvious. But the hardest part is that a successful trader has to accept risk. What does that mean? You hear it all the time, right? People talk about accept risk. Well, what does that mean? This means that you're fully willing to lose a trade as an acceptable outcome of the trade. That means you're not going into a trade saying, I'm going to win this trade. Because that's what you do. We all do that, right? We all want to win the trade. That's the objective of trading, is to win more trades, right? And win bigger trades, right? That you want the trades to be bigger. You don't have to win more trades than you lose. You just have to win bigger than you lose, right? Overall. You can have a win rate below 50% and be a profitable trader. There's plenty of examples that you can see of that, right? But if you can't accept that you're going to take losses, you're just going to have a hard time trading. That's the cost of doing business, right? You have to accept that one of the outcomes is a loss. And this is the hardest thing for so many people, right? If you have a smaller account, it's really hard to see something go against you and to lose money, right? It's not an easy thing, or even if you have a big account. But smaller accounts is even harder, right? For the folks that are getting started with this, it's difficult. It's a tough pill to swallow. But at the end of the day, that is the cost of doing business. So if you want to be able to get a reward, you have to be willing to risk something. And that's just the fundamental aspect of this. So you're going to have a heart-to-heart with yourself and be willing to accept that risk. You have to be willing to do that. Now, you can't eliminate losses, right? There's nobody that I know of that has 100% win rate. And I think that's not a real thing, right? I don't think that's possible. You can minimize the losses by taking, high probability setups, just taking fewer of them, and or by having just way better execution, right? You can definitely ramp that win rate up, but you're not going to eliminate losses. There are going to be losses, and that's okay. That's part of the game, right? You just want to make sure those losses are small and managed and within your risk. And what does that mean? Well, everyone who's going to trade should know their risk per trade. We'll call it R, right? And risk per day, right? Or per week or per period, right? Some multiple of R. If you're a day trader, it's speed for day, whatever. You figure it out, whatever period you're looking to trade on. But there needs to be some caps on the amount of risk you're willing to have on a per trade basis and a per period basis. And these can be fixed dollar amounts, $100, $10K, $100K, $1 million, $50 million, whatever it is, right? And everybody's got different account sizes. So it can be, it's going to be different for every person. Or it could be a percent of P&L, like 1%, 2%, 3%, 4%, 5%, whatever, right? 10%. But you have to know this value before you take a trade, right? And you don't want to have it be too high, right? Full port, 100%, half port, 50%. You don't want to do that. That's not the way you're going to grow in a meaningful way, right? If let's say you have a great win rate, you're on a streak and your win rate's super high, and you just get overconfident and you start sizing up, right? Oversizing. And then the market changes. And what was working well for you before that was helping with the win rate being so high is no longer high anymore, right? And all of a sudden, your setups are just not working for some reason, right? You could blow up the account. So by risking, a smaller piece of your account on a per trade basis, you'll be likely to, on a let's say 10 trade or 50 trade basis, if you get a string of losses, you're going to be able to withstand that versus oversized. This is a common problem. There's a lot of new traders that oversize their position in hopes of big riches. Again, greed taking over for us there. And it usually doesn't end up well. You see tons of examples on this in social media, Reddit, X, everywhere. So, it's important to figure out a reasonable R value for yourself, and then, know what that is. You need to know what that is. Anytime you take a trade, you need to know what your risk is. So once you understand your R value, you can start to use that to determine how you lose a trade. I'm going to say that again. You can use that to determine how you lose a trade. Now, we always talk about winning trades, but it's important to also think about how you're going to lose the trade, right? It's very important, right? What's going to happen if my risk is completely met, right? And how am I going to manage that? What's my execution look like? And it's actually a pretty simple concept. So you're going to size your position based on your stop and your entry, right? You work back to the entry to find the dollar difference between your entry and your stop, and then size the position based off that distance, right? See, this is what a lot of people don't do. They just randomly buy a certain number of contracts. They have some sort of arbitrary percent risk, usually not a technical risk. The market doesn't give a shit about your 30% stop. It doesn't know anything about your 30% stop. It knows about a certain level. And so that's why technical stops are better. So it's better to use a technical stop and work back to your entry, find the difference, and then size accordingly based on that difference. And for shares and futures, I think this is pretty straightforward math. You've got, shares, it's just a dollar amount. Futures, it's going to be a per contract point amount. And then options is the most challenging, but you can somewhat approximate it, in a similar dollar fashion using the contract delta. And of course, delta changes as you go up or down on the underlying. As you go more in the money, it's going to go higher, and as you go out of the money, it's going to go lower. So it's not a perfect approximation, but it can be used, in an effective way to set up your risk. And I'll show you that in a second. I'll show you an example. There's going to be hundreds of examples, but I'm only going to show you one per type here. So let's use the simplest one. Just a random stock. There's no actual ticker value. I'm just using made up numbers here for the sake of discussion. All right. So let's say our R value is $1,000. We're willing to lose $1,000 on the trade. The hope is we can at least get a double on our risk. Of course, that's not always going to work out. Sometimes you may need to exit early, but as long as the trade is working in your favor, you're going to accept the risk and try to shoot for your reward. So let's say your R is 1,000. Your entry's at the share price of $20. You're hoping for a profit. Let's say there's a prior swing high that you're trying to hit of 30 at 30, so $10 per share reward, and then you have a stop at $15. Let's say this is a technical level below, which indicates $5 is the per share risk. So how are you going to size this? Well, if your stop is 15 and your entry is 20, there's a $5 difference. That's your $5 per share risk. So at that point, you can get 200 shares at $20 for $4,000, right? $4,000 is your principal. A 25% stop on that will take you out at 15 for a $1,000 loss, which meets your risk. And a 50% gain on the overall will net you $2,000 profit, which would be a 2-to-1 or 1-to-2 risk reward. And that would hit perfectly at our $30 target. So pretty simple. You're going to enter the trade at 20. You got a 25% stop or a fixed stop of $1,000 if you want. So in this case, it would be $5 per share. And then you would have profit taking at $30. So shares example, I think, makes the most sense. Pretty straightforward, easy to kind of understand. And I think futures is relatively similar. We can talk about that next. And these are all long examples. Short, same way, right? It's just opposite direction. Contracts for options will be the same, but for futures and shares, you can just think of it in the opposite direction. So futures work kind of similarly to shares, except that you're buying a contract with a per point move associated with a gain or loss. So we'll use 50 per point as, for this example. That's basically like ES. If you trade ES, it'll make sense. But different futures contracts have slightly different per point values, and so we're just going to use ES for this example. So let's say you have, again, an R value of 1,000. I'm just going to use 1,000 for all of them. Let's say your entry's at 5,800, looking to take profit at 5,820. That would be $1,000 per contract reward. Your stop's at 5,790, so 10 points stop below, and that's a $500 per contract risk. So 2 contracts at 5,800. A 10-point stops at 57.90 is going to give you a $1,000 loss, which meets your risk. 20-point gain is going to at 58.20 is going to give you a $2,000 profit for a, again, 1 to 2 risk reward. So options are the trickiest, but they're also the most flexible way of managing risk. You can do it through sizing. There's plenty of traders, great options traders out there that do not take any stops, and they purely trade based on size, and that works great for them. And you can do that too. For short-term options trades, I rarely will trade with a stop because the volatility is just so high. Your stop will get taken out, and then it'll move in your direction. Options are amazing because you can do so many different strategies. There's things like spreads and various other things you can do where you can manage risk in a very reasonable way. So I won't get into that. There's so much detail. I'm just going to talk about basic directional trades, which is what I generally trade. And for basic directional trades using options, you can use delta as an approximation. It's not going to be perfect. As the underlying goes up and your contract goes in the money, or deeper in the money, delta is going to go up as well. And if it moves against you and your contract goes out of the money, delta is going to start to go down. So delta is not going to be perfect, and we'll use at the money to make it a simple example. But you can start to look at things from this standpoint and kind of use delta as a nice approximation, and it should largely work for you if you use that methodology. So something to note, options obviously have time risk. There's theta that's influencing the premiums as well. And this is more noticeable as you get closer to expiration. So certainly having extra time on contracts relative to the period in which you're trading it is very important. Most people should probably get more time than they think they need on options contracts. I think a lot of people are focus too much on big percentage gains with short-term contracts. And while you can trade those effectively, and plenty of people do, I think, for most people who are struggling with options trading, it's best to get extra time. So let's jump into a calls example here for options. Again, random name. There's not a real name. I'm just using random numbers to make it an easy example for you guys to understand. So same R value, $1,000. Delta is 0.5 at the money. Delta is going to change higher as it goes in the money and lower as it goes out of the money, right? So entries at $100 underlying, which we're going to take an at the money contract, 100 calls. I didn't give an expiration here. It doesn't matter. We'll just assume that it's enough time, maybe next monthly or whatever. And the contract price is $2, right? Profit at $2 at 102 underlying. The contract price will be $3, or roughly 100 per contract reward. And our stop's going to be at 99. Let's say that's a technical stop just below. And at that point, the contract price will be about $1.50, or $50 per contract risk. Now, for those of you not familiar with options, the premium is for a contract which is 100 shares, and so you have to multiply the premium cost by 100 to get the total cost of the contract. So $2 is actually going to be $200, $3 is going to be $300, $1.50 is going to be $150. So I hope that makes sense. So for the sizing, 20 contracts at $2 is going to be $4,000 principal. Stop at $1.50 is going to give you a $1,000 loss on those 20 contracts, and taking profit at $3 on the premium, which would be at 102 roughly. Underlying is going to give you $2,000 profit. So kind of three ways to do the same thing: shares, futures, and calls. But in these cases, our risk is managed. We have clear places to stop, clear places to enter, and clear places to take profit, with a known, plan for how to do that. And I think that's the most important part of the risk management. So hopefully that clarifies things for many of you. So the final thing we'll talk about, and then I'll let you go for this episode, is continuous improvement. We kind of talked a little bit about this in the growth mindset section, but kind of want to tie it all back together. So you have to have a growth mindset. And in order to do that, you got to record everything. You're going to be like a scientist. You're going to write everything down. You're going to journal it all. You're going to keep track of your trades. You're going to include the reasons for entering and exiting, what your emotional state was at the time when you entered, or if you exited, what was your emotional state, and then what happened. Not just what happened to your trade, but did it eventually go in your favor, right? If you got out early, did it eventually go in your favor? If you held too long, was there something you could learn from that? And of course, you should go through your journal regularly, right? We talked about setting up a routine during the discipline section of this video. You got to go through the journal and study it and be objective, right? There's no right or wrong. Nobody's going to, laugh at you. This is your journal, right? It's you and yourself. And you have to be honest to yourself. If you can't be honest to yourself about what you're doing, you're not going to get better at it, right? That's just a simple thing about life, right? If you cannot acknowledge that something is not true, you're doomed to repeat the same thing that you've been doing over and over again. So periodically, you got to analyze your journal and then figure out what you can improve, right? And also, no strategy is going to work 100% of the time. You have to adapt over time. There's, hopefully your systems that you've used are adaptable, or at least somewhat conducive to providing you, something that works across multiple tickers, and, multiple markets. But, it may need changes over time, right? I have a system that I've been using for a couple years, and I made tweaks to it, right? It's changed, it's evolved, it's improved. But, that being said, I think it's also important that you don't fall into the trap of constantly changing your system. That's going to make it even, you're basically going back to ground zero. We talked about not trading impulsively, not trading randomly. Well, if you're constantly changing your system, you're back to a random trading state. Right? It's going to be hard to trade that effectively. If you don't have a baseline for what works, then you're never going to know what works. Right? If you can't test against that baseline, and hopefully you've back tested it, but at the end of the day, you should also know that it works for you, right? Constantly changing something is just putting you back into a random state. Now you're going to be trading impulsively, you're going to be trading randomly, and it's going to be very difficult. So, be willing to make changes, be willing to make adjustments, get better, improve yourself, improve your system. And then, final point I want to talk about, trading is lonely, right? There's a lot of people out there trading by themselves very successfully. But it's important that you have people to talk to, that you can teach and that you can learn from. I'm fortunate I built a great community that I get to teach and learn from. It's super helpful to have a support system like that, to have like-minded traders that share positivity and can, give you constructive feedback. So, it's important if you're, to find a community that you can grow with. That's really important. And so, as you are looking to improve yourself, it's kind of hard to talk about trading with people who don't trade. Most of them either think, they fall into a few camps. They think it's gambling. They think it's wizardry. They glaze over and then just don't want to, move on, different topic. So, I get that. And, so make sure you find like-minded folks that you can discuss with. Focus should be on continuous improvement. So you can review what you're doing and get better from that. You can review your strategy and your system and get better from that. And you can talk to others and get better from that too. And that's it. So that's episode 1 of Basic Trading, and managing yourself, which is the hardest thing you're going to do in trading. You, at the end of the day, are the final boss. Your ability to have the right mindset and attitude, to be disciplined about your approach in trading, to have emotions but not let them influence you, to manage your risk and make sure your winners are bigger than your losers and your losers are small, and to continue to improve. That's going to be the thing that takes you to the next level. The systems and TA and flow analysis and all that stuff, and we'll get to that. We're going to get to all of that. But all that stuff is easier. Getting to the bottom of things with yourself will be your greatest challenge. And so that's why episode 1 is about managing yourself. And I hope you found this useful. I know it's been a long time coming. It took me a little bit of time to think about all this stuff and put it together. But I hope you find it useful, and I wish you the best of luck with your trading and with learning more about yourself and learning how to manage yourself.